Hi there, thanks for stopping by. Let's check out the ultimate guide. Build a $1,000 plus per month passive income dividend portfolio. The step-by-step guide. Before we dive in, if advertisements should interrupt this video, please do not click off of the advertisements. Please allow them to play through as a thank you to me for bringing you this honest, valuable information for free. Now let's continue. Have you ever looked at your monthly expenses, your rent, your mortgage, your utilities, and wondered what it would take to get just one of those big bills covered by your investments? Not by working more hours, but by letting your money work for you? Specifically, by having a passive income stream of over $1,000 per month hitting your bank account automatically every single month. If you're searching for the exact blueprint to create a reliable dividend growth portfolio that generates true monthly cash flow, you've found the ultimate guide. Most people think building a gigantic, consistent dividend portfolio is too complicated, requiring special knowledge or enormous starting capital. That's simply not true. It requires a specific, actionable strategy. Today, we are moving past theory and into pure action. I'm going to walk you through a clear, three-stage system that transforms your current savings into a wealth engine, focused entirely on delivering that $1,000 plus per month passive income goal. This isn't a quick flip. This is how you build long-term wealth accumulation and financial freedom using the power of compounding. To truly master this, we first need to understand the single most powerful concept that makes this goal realistic: the compounding effect. Dividends aren't just a nice little payout. They are a resource that, when immediately reinvested, buys more shares, which generate even more dividends. It's a self-fueling engine. Our entire strategy is built around maximizing this cycle to achieve our target monthly cash flow. Our guide to building over $1,000 a month passive income dividend portfolio is broken down into three logical and essential stages. Stage 1. The Accumulation Accelerator, funding your portfolio. The first and often most challenging step isn't picking stocks, it's optimizing your funding. Even the best dividend investing strategy fails if you aren't consistently feeding the machine. This stage is about setting up a powerful, reliable stream of capital. First, you must establish a dedicated dividend portfolio account. This should be separate from your day-to-day trading or short-term savings. For maximum efficiency, utilize tax-advantaged accounts like a Roth IRA or a traditional IRA first. Why? Because the entire point of a dividend portfolio is income, and placing that income stream where it's protected from annual tax hits supercharges your compounding returns. Every dollar saved on taxes is another dollar buying more shares. Next, implement a non-negotiable, automated investing schedule. Set up an automatic transfer from your checking account to your brokerage account on the first day you get paid. The amount isn't as important as the consistency. This harnesses the principle of dollar cost averaging and, more importantly, ensures your portfolio grows regardless of your emotional state. Think of your portfolio like a huge magnet. We are steadily feeding it small pieces of metal, your contributions, so it can grow stronger and start pulling in bigger pieces on its own, dividends and capital appreciation. This consistent input is the foundation for achieving your gigantic dividend portfolio goal. Stage 2. Precision selection, finding the reliable dividend engines. Once your funding stream is solid, we move to the selection process. This is where most casual investors make critical mistakes, chasing high, unsustainable yields and falling into yield traps. Our focus is on dividend safety and dividend growth rate, not the current raw yield. To build a $1,000 plus per month income stream, you need companies that are committed to increasing their payout every year. We call these dividend champions or dividend aristocrats. They have a proven history, often 25 to 50 years, of hiking their dividend. An increasing dividend provides natural inflation protection and ensures your $1,000 plus goal keeps pace with the cost of living. Here is the actionable process for screening potential investments. Check the payout ratio. This is the most crucial metric. It tells you what percentage of a company's earnings is being paid out as a dividend. A payout ratio consistently above 70% or 80% is a massive red flag, indicating the dividend might be unsustainable. Look for healthy, safe ratios, typically between 30% and 60%, which signals the company has plenty of cushion to handle economic downturns and continue increasing the payout. Verify the dividend growth history. Use a stock screener to filter for companies that have increased their dividend for at least 10 consecutive years. This demonstrates commitment, financial stability, and management's dedication to rewarding shareholders. A company that grows its dividend by 7% per year will double your income from that investment in roughly 10 years, without you lifting a finger. This is the definition of powerful compounding returns. Assess industry diversity. Do not put all your eggs into one sector. Your portfolio must be diversified across 8 to 12 industries. Think utilities, consumer staples, technology, and healthcare. This is your primary risk mitigation strategy, protecting your passive income streams during sector-specific downturns. Stage 3. Compounding Mastery, the path to over $1,000 a month. The final stage is turning the dividends you selected into a fully automated monthly income machine. This requires precise calculations and the non-negotiable use of dividend reinvestment plans, or DRIPs. First, the calculation. To know how much you need to invest to generate over $1,000 a month, or $12,000 plus per year, you divide your target income by the portfolio's average yield. If your portfolio has a conservative, safe 3.5% average yield, you will need a total portfolio value of approximately $343,000. That number might seem large, but remember, the clock starts now. Every dollar you invest and reinvest is marching toward that figure. This is your definitive long-term wealth accumulation target. Second, the automation DRIP. You must enroll all your dividend holdings into a DRIP. This means every time a dividend is paid, your brokerage automatically uses that cash to buy fractional shares of the same stock or ETF. This eliminates the frictional costs of trading and maximizes the compounding returns. It is the single most important tool for accelerating your journey toward a gigantic dividend portfolio. The growth you achieve from reinvesting dividends is exponential and, crucially, requires zero effort on your part. It is the definition of passive income strategy. Third, rebalancing for stability. Once a year, review your portfolio. Due to different growth rates, some stocks will have grown larger than you intended. Rebalance by selling a small portion of your high-performing holdings and using that cash to buy more shares of your underperforming, yet still fundamentally safe stocks. This keeps your diversification on track and ensures your risk level remains appropriate for your long-term wealth goals. Crucial compliance check. The mistake that could cost you. Before you implement this, here's the mistake that could cost you years of lost income and stability. Chasing the yield trap. A stock or fund offering an astronomical 8%, 10%, or even 12% yield is almost always a sign of a company in deep financial distress. They are often paying out more than they earn just to attract new investment, and the dividend is destined to be cut or eliminated when the company's revenue falls. When a dividend is cut, the stock price usually crashes, wiping out your capital and your income streams simultaneously. The authoritative, objective approach is to prioritize dividend safety, low payout ratio, long history of growth, over high current yield. A safe 3.5% yield that grows every year is infinitely better for your retirement portfolio than a risky 8% yield that disappears when you need it most. Stick to the metrics and trust the process, not the hype. Conclusion and your next step. What you have now is the entire actionable step-by-step framework to build over $1,000 a month passive income dividend portfolio. We defined the goal, secured the funding stream, implemented a rigorous selection process based on dividend growth rate, and mastered the power of compounding through drips. You now have the knowledge not just to invest, but to transform your financial future. Remember the biggest takeaway. Consistency beats brilliance. Small, automated contributions and the relentless compounding of safe, growing dividends will inevitably lead you to that $1,000 plus monthly target, and beyond that, to true financial independence. Now, let's quickly summarize the biggest takeaways we covered. We established the need for consistent funding, emphasized prioritizing dividend safety over high yield, and detailed the crucial role of DRIP in achieving exponential compounding returns. If this ultimate guide has given you the clarity and confidence to start or restructure your own dividend portfolio, please do two things. Leave a comment below saying this video was very helpful and tell me what your monthly passive income goal is. Even if it's $100 to start. Click the thumbs up button to like the video. It helps this crucial financial literacy content reach more people who need to build their own passive income streams. And finally, subscribe to the channel right now. In our next video, we will dive deeper into the specific ETFs that make global diversification simple and tax efficient, further accelerating your path to long-term wealth. Don't miss it.